Good afternoon, everyone. My name is Roshan Kanesan, Senior Financial Planner with RinggitPlus Financial Planning, and I'll be your host for today's webinar themed Getting Financially Fit. On behalf of HSBC Malaysia, I'd like to thank all of you for taking the time out of your day to join us today as we explore ways we can start our wealth journeys. Now, why is this important to talk about? Because let me set the stage a little bit here. Right. So according to survey results from RinggitPlus's 2021 financial literacy survey, it was reported that 45% of Malaysian millennials spend more than they can afford. That's one issue, right? The more important issue, or the thing that I found particularly distressing, it was discovered that 57% of millennials would not be able to survive more than 3 months with their current savings on hand. This is particularly alarming as it signifies the lack of access or emergency funds during times of need, and your emergency fund is your first line of defense during any kind of financial distress, whether it's simple things, medical issues or car breakdown, or even things like job loss or income loss, which is something that we've seen over the last few years. This is why it is crucial for us to be open about the topic, have these conversations, and have meaningful conversations about personal finances, about financial planning, about money, on how we can better manage our finances, as well as grow our existing wealth. Taking that first step is vital to set ourselves up for for financial success going forward. And today we're bringing you a panel to explore this and more. And I'm particularly excited about this, actually, and to help us in this session, please give a warm welcome to Ken Voon, Head of Wealth Development at HSBC Malaysia, Suraya Zaiudin, Ringgit, and Raymond Tan, the Black Belt Millionaire. To all three of you, welcome to this to the session. Let's get to know them a little better, shall we? First and foremost, Ken, could you tell us a little bit more about yourself? We'd really like to, what are you doing here at HSBC and what are you focusing on for today?
Sure. Thanks, Roshan, for the warm welcome. I'm Ken, and I've been with HSBC for over 13 years now. I'm currently responsible for overseeing the retail investment business, covering unit trusts, structured investments, retail bond, and foreign exchange. I'm really looking forward to having an insightful conversation with my fellow panelists, and just can't wait to get it started.
Ken, thank you so much for that. Looking forward to your thoughts and your insights as we go through this session. Also weighing in today, we've got Suraya Zaiudin, founder and editor of what I believe to be a fantastic personal finance blog, Ringgit. Suraya, always a pleasure speaking with you. Would you mind giving to the few people who don't know who you are, introduce yourself, please?
Thank you, Roshan. You're too kind. Hi, everyone. I'm Suraya. I run Ringgit or Ringgit.com. I'm also an associate financial planner. I'm a writer and I'm a speaker. I'm a digital marketer. And basically, Ringgit is where I write about my financial journey in the beginning, but now write about like all sorts of money topics. So I can't wait to bring some of those discussions into today's discussion.
Thank you for the introduction, Suraya. As always, I look forward to your insights here. And when it comes to the personal finance space, it does feel like a very grounded, relatable angle. And on that same note, actually, I'd like to welcome now Raymond Tan, the Black Belt Millionaire, also a personal finance blogger. We've had a chat before, I think it was earlier this year, or was it last year, but also brings a relatable angle to personal finance, which I believe is so important. Raymond, a brief introduction of yourself, please.
Thank you, Roshan. And I'm really thrilled to be part of the conversation today. And my name is Raymond, and I run Belt Millionaire website, where I do provide insights on my personal finance journey and also continue to invest habitually. And of course, for those who are unfamiliar with my background, I'm a professional martial artist and also a serial investor. Thank you so much.
Thank you, Raymond, for that. Ladies and gentlemen, I don't know about you, but I am excited to get the ball rolling today with these amazing guests that we have. So without further ado, let's get right into it, right? And the first question today goes to Raymond. Raymond, as a former martial artist, fitness is something that's so often talked about, right? In terms of our physical health, in terms of our mental health, and also our emotional health. These things kind of tie together. But something I believe that we don't talk about enough is financial fitness, which is the theme of today's conversation, of course. But it's a conversation that we don't bring up as often as we should, talking about money, having meaningful conversations, as one of the theme is today. Raymond, why do you think, why is it equally important to be financially fit now more than ever?
Thank you, Roshan, for your question. Let's just take our body as an example. There's a saying goes that we are what we eat. And our effort spent on working out, eating right is a direct result on how our body will look like. So take an example for this. Our body is actually a temple, and if we take good care of them, we are able to live with longevity. This is all relatable. So how does it relate back to personal finance? As I mentioned earlier on, good habits such as eating right, working out will lead to longevity. Imagine our financial or savings being similar to our body, and if we feed our body with the right food, which equals to the right knowledge in investing, and working out often, which equals to investing often, it will lead to longevity, which is having more savings and wealth.
Raymond, thank you for that. And I really do like the analogy here, right? Because at the end of the day, there are certain parables that we can make in terms of our own bodies and certain financial assets or certain parts of personal finance to make things more relatable, right? So something I like to say is that cash flow is like your blood, right? Nothing moves anywhere without cash flow. Your heart can be, I don't know, where you asset allocate. Those are different things. And we could go have an entire conversation of that a bit later, maybe. But for now, Raymond, thank you so much for that. I like the relatability here and how you've related it there. But on that note, on financial well-being, and which has been a concern for many, especially recently with all the market turmoil that we're seeing, I'd like to take the conversation over to Ken, please. Now, Ken, on a similar note here, where do you think financial fitness comes in during such a volatile time for many?
First, I'm of the view that financial fitness is paramount to one's success and is crucial to enjoy a balanced lifestyle. With the rising cost of living, it is vital for us to find as many avenues as possible to make our money grow passively as opposed to just actively. At HSBC, we are constantly deriving new ways for Malaysians to invest their expendable income, allowing them to grow their wealth further. This begins with lowering barriers of entry, making investing more accessible to younger generations so that they may pick up the habit sooner. Aside from this, it is also important to impart the fundamentals of being financially savvy onto Malaysians through resources such as conversations that bring awareness to the topics such as this, along with the tangible resources that we can use to better manage our financial well-being.
Thanks, Ken. I particularly like the point about lowering barriers to entry. Right? And this is a very, very popular thing we've seen over the last few years. And it's become an important element as we take a look at getting people more financially involved, giving them access to getting involved in global markets, for example, as opposed to just having a local home bias here. So that's really fantastic to hear. And actually, Suraya, I'd like to move the conversation over to you now, if we could, please. As someone with let's just say a lot of experience in the personal finance space, I'm sure you've come across many people seeking advice on personal finance amidst these market uncertainties now and before. And I mean, I've personally seen this on Twitter as well. So what are some of your thoughts here in terms of how does one prepare for these kind of uncertainties and these kind of surprises?
The thing about surprises, Roshan, is that it's so annoyingly common. Sure, everyone here can relate, right? There's always that unexpected expense every single month. If it's not car related, it's house related. If it's not house related, it's like a random bill or random saman. If not that, that's like you lost your house keys or something breaks down. There's always something. So the only way, unfortunately, to prepare is by having savings. And I know that is annoying, but you must have savings first. You need savings, not just to prepare for these kind of emergencies, but also you need savings so that you can invest, obviously. I think like first and foremost, many people, myself included, when I first started out, I wanted to invest first before I knew about the foundation of savings. I wanted to learn how to invest in all this risky thing before I have my emergency fund sorted out. So it's like jump before you leap kind of thing. So, but I also got lucky. So I think this is where I thank my lucky stars a little bit. Number one, I am privileged enough to have the support of my family when I was young. I had that network, and that allowed me to work during college and also work 3 months at 18 years old. I was working as an insurance telemarketer for 3 months. And that particular job, even though as boring as it was, insurance is amazing now, but at the time it was boring. That helped me to save my emergency fund. I saved over 5,000 ringgit. I remember I was like 18 years old. So at that time, having those savings means that even by that age, I have way less financial anxiety compared to other people. And because I have less financial anxiety, I can afford to try out, put 100 ringgit here in different investment, buy money for books, buy courses. I feel that that job basically changed my life. I just want to say that for everyone else, right? If you want to invest, but you feel fearful, it's the only way that you can prepare is to do your best to accumulate at least like 3 months of living expenses just so that you can overcome that financial anxiety. And I know that it's very easy to say, hard to do, but it's actually very, very doable. For me, it took a very stressful 3 months, but at the end of the day, it's just a few short months in exchange for years of peace of mind. So that's something that I want to remind everyone. Have your foundation first before you jump into investing.
That's right. That in itself is probably one of the most important things people are going to hear today, right? Building that financial foundation is vital. And I personally, when I talk to clients, it always comes down to 3 things, right? It comes down to your emergency funds, whether you have free cash flow or positive cash flow. And the third one is whether you have adequate protection. So that's adequate insurance or medical insurance or that sort of thing, right? Insurance needs will differ depending on where you are in your life stage, but these things set the financial foundation so that you can go and do other things like invest in growth or have a diversified portfolio. These things are boring, but they're so important. And it all starts with getting started on it. Even if it's a little bit, you just build that up over time. And as Suraya said, it is easier said than done. There are people who are going to struggle with this, but you will be very thankful for it. Actually, 2 years ago, right, was when the MCOs first started in Malaysia. And in my previous job, I was in radio. So it was a bit volatile at that point. So that's when you start thanking yourself for these things that you put in place, the foundations. And speaking of that, COVID-19 is now basically a part of everyday life. But back in 2020, when it first surfaced, no one saw it coming, right? That's the definition of a black swan event. No one sees it coming, which brings us back to this question for Raymond, actually. COVID seems to be here for a while longer, and we're seemingly in a constant limbo in terms of how do we deal with it, living with it on a daily basis. Their daily case numbers are high, although they are falling. How did the pandemic impact your investment strategies and behaviors? And what were some of the key lessons that you learned along the way? I think this would be really important for people to hear, to understand, to bring a human element into personal finances and investing.
Thank you, Roshan. I personally see this as an opportunity, especially for those who are investing habitually. Personally, I stay invested in all the investments that I used to invest in, and I do live by a quote that goes by, be greedy when everyone is fearful and be fearful when everyone is greedy. It is actually a famous quote by Warren Buffett. On many occasions, many people are able to make money during the market downturn. So take as an example, when the pandemic just started, I was quite optimistic that we are able to get this done and over within 1 year. So that's what I'm actually looking forward for, but I'm wrong in that sense. But what I stay invested in certain sectors such as food manufacturing, energy, healthcare, transportation, and all these sectors are all essential sectors that we're supposed to look into from the start. And despite there's nothing much changes in terms of the stock prices and all, maybe there are some that doing well, there are some that not doing well. But if you're still invested in all these stocks and all, you're able to see like long-term outcome. So since I'm investing in a long-term outcome as well, I feel that over the period of long term, the return itself will be particularly good in terms of 5 to 10 years to come.
Thank you for that, Raymond. So I guess when we bring that back to that, or just relate back to that question, the beginning of the pandemic was certainly, I think, a scare for many, if not all of us. I myself reevaluated investment strategies, but also reevaluated my emergency funds, right? Back then I was like, oh, that's boring. I'm going to focus on other things. When that sort of thing is in your face, you reevaluate what's important and learn from, I guess, that scary moment. But thanks for sharing your experience and your investment strategies from that point, Raymond. Getting into the practical side of things, though, I'm sure that we all use a variety of tools in one form or another when it comes to budget tracking in an app or a spreadsheet or even a analog logbook. There's nothing wrong with that, ladies and gentlemen. Sometimes it's very intentional when we use a logbook, whether this is in the expense side of things, but also other more complicated tools to keep track of our investments. So I want to throw this to you here. What would you say are the financial tools that you regularly use? And are there any in particular that help you track your finances, both from the expense side and the wealth building side?
Sure, Raymond, I'm happy to take this question. If you follow me on Ringgit, you will know that I'm a big fan of expense tracking. In fact, I'm obsessed with expense tracking. I share it every single month. I use this one app called, I won't show you, but I'm used to this one called Money Lover. I actually got it about 5-6 years ago, and it was only around like 10-15 ringgit. But when I last checked, I would recommend it to you, but now it's around like 70 ringgit. So I think it's a great app, but it is also a bit steep. So you can use other apps out there. And I believe that later HSBC will also be recommending some tools. You can use those recommendations. But aside from that, like how you want to do your budgeting or expense tracking is really up to you. I love using like plain old notebooks. I believe in brain dumping. I believe in clearing mental clutter, they call it. I use Excel. I use Google Sheets. I use it to track my income and do accounts. Nothing specifically fancy. I think that if you are someone who like is an Excel nerd, I know some people are like proudly Excel nerd, right? You can have fun with this. Like you can do all your nice tweaking, like all the random button all. And if you love putting pen on paper, you can do like a really nice like journal spreadsheet. So those are options for you. And then when it comes to wealth building, the tools that I want to give out are probably things like I would consider there's really like no one specific tools. There's just so many tools out there, and I guess I love trying them out. I use a combination. I guess the most important thing about those wealth building tools is that use the ones that are given or prepared by legitimate companies, legitimate entities. So don't use like the weird ones. The weird ones, maybe, it's that one could be scam. So only use the ones that are promoted by companies licensed in Malaysia and things like that. But another type of tool that I think is really important that people don't know about is probably questionnaires and personality tests. You should know your own behavior better. And the reason why I say this is because you don't really have a sense of your own behavior until this gives you the best understanding of your own behavior before you actually try out different investment strategy, wealth building strategy, whatever you want to call it. So for example, some of these questionnaires, personality tests, they're actually embedded inside investment apps, right? So for example, they would ask you, like in this quiz, they would ask you, what would you do if the market dropped? Like, would you sell or would you hold on to them, for example? So you should try those out and just see, like, for example, like what funds they recommend to you. You should see like what they say, what type of investor they say you are. You could think that you are an aggressive investor, but the questionnaire tells you to take it down a notch and stick to like moderate or like conservative. So, use these kind of tools to help guide your investment behavior. Don't think that you know yourself. Like most people don't really know themselves, I found out.
Sorry, thank you for that. Many great points there from the tool side, from the behavior side, which again, super important, right? How we understand our own behaviors can really impact what is reasonable versus what is rational for each individual, which is so important. But you mentioned a few tools there. I bought an expense tracker with my iPhone 4 in 2010, which I still use till today. I bought it for $5 at that point. One of the best things I've ever bought. I obviously, being a human, made a lot of mistakes, and there were years I didn't track my numbers. But that's okay, guys. It's about measuring as much as you can so that you can learn how to manage. So what I did was I would measure for a certain amount of time, and then I'm like, okay, I've got a certain amount of like, I have a certain trend here, so I can kind of now maybe not measure as actively, and then kind of manage it from there. Do what works for you. And I think Suraya mentioned spreadsheets earlier. I am an avid fan of spreadsheets. I love building them. I love using them. There are a few comments in the chat that I do want to highlight, which I think are amazing. Liana Mokhtar said she's a proud Excel nerd. A shout out to you, Liana, for being a proud Excel nerd. And then we've got Daniel Koh, which I think is a comment which I think is so relatable. 30 minutes designing the sheet, but only spend 5 minutes keying the data. I feel you. Sometimes I spend more time building sheets than I actually spend using them. But it's really, really good to hear that people are building their own tools, that they are excited about the different things that are out there. Find a way that works for you. Find a way that makes a difference for your own personal finances. There are a great number of tools out there that you can use. But remember, as Suraya said earlier, I think it's important to see where the tools are coming from, right? And kind of just be selective with that. Now, moving on from there, now that Suraya has basically spilled the tea on what she likes to track or how she likes to track her financial moves, let's move over to Raymond, because I'm also curious what your habits are and routines are when it comes to investing, right? How much of it would you say is a habitual process versus the need to be on your toes and switch things up? These are two, they're not mutually exclusive, Raymond. So how does it work for you?
Thank you, Roshan. It is actually part of the habits where we started off like a baby and all. So when I started to invest, I used to track my investment on daily basis because I'm really, really excited at that point. So I used to track and keep up with the market trends and movements of the stocks and all. But eventually, when it comes to a point where I realized that instead of looking at the short-term trend itself, I try to focus on looking at the long-term trend, which is the buy and hold method, which is also something that is practiced by Warren Buffett itself. So instead of looking at the particular stocks and the market and all, instead of tracking the stock price on daily basis, what do I actually focus on a lot is actually on their annual financial report. And from there, you're able to uncover lots of stocks that are actually undervalued. And also you're able to purchase them at discounted price. So let's just take an example. In the market itself, there are property they're selling around 1 million ringgit. But when you're looking at the purchase price itself, you're able to purchase it at 500,000. So to put it in a simple layman terms, you're actually purchasing undervalued stocks by just looking at the annual financial report. So aside from that itself, aside from stocks investing, there's also one more strategy that I'm actually using for my other investments, such as PRS, robo-advisors and all, where I'm using the simple dollar cost averaging method to invest as well. So what do I see from there? It is actually long-term investment are able to have long-term solution back in terms of our financials and all. So when we look into that itself, investments such as robo-advisors and all, they are focusing a lot on long-term investment. And all you have to do is do your initial homework and find the right platform to invest in. And from there, like what Suraya mentioned earlier on, there are certain questions that you're able to answer. And once you go through this questionnaire and all, you will know what type of investors you are from there. But one more tips from here is do check out those platforms whether or not they are certified or approved by the Securities Commissions of Malaysia.
Raymond, appreciate the insight there. I personally believe it's always helpful to hear and learn about different investing perspectives so that we can inform and build our own processes. And I hope all of you feel the same. And I think I just want to highlight this point in particular because the process is important, right? When you're looking to, in particular with stock picking, right? If that's something you're interested in doing, ensure that you understand what you're doing in terms of what are you buying, right? What are stocks? They're businesses. And when you're buying a business or you're going to build a business, you're going to want to look at things like growth in terms of earnings, right? There's always going to be a particular amount you're willing to pay to buy a particular business. So a lemonade stand that makes a certain amount of earnings, there's a certain amount of money you take to buy that lemonade stand. So the lemonade stand is actually a very common example that's used online. So I recommend people search that up in order to understand why earnings and PE ratios and growth rates are important when it comes to stock picking, but also when you buy unit trust funds or ETFs or anything like that, it's important to understand what's driving the valuation in these things, right? Because if you don't understand if you don't understand the value of why a stock is a certain price or why a ETF or unit trust is a certain price, then it can get a little dicey during times where everything is falling, like what's happening right now. On that note, speaking of approaches, Suraya, correct me if I'm wrong here, but you're known to be a more aggressive investor or have a more aggressive investing style. So tell us, is that still the case today? And if so, what is generally your preferred strategy to minimize losses, or what do we need to, I think, better equip ourselves when making high risk, high reward decisions?
Thanks, Raymond, for the question. Actually, I started out being a super conservative investor, and then eventually it turned to more aggressive. And I guess if you look at my overall portfolio, you're not wrong because it is technically high risk. I wouldn't share what's inside my portfolio, but it is extremely high risk. But here's the thing. In my particular case, it is actually the result of applying barbell investing strategy. And it's everything to do with luck and less to do with my own investment, I guess, skill. I'm just going to explain what barbell investing strategy is, if anyone is unfamiliar. I'm going to oversimplify, by a lot, but basically this is when you invest the majority of the portfolio in low risk investment, what I did, right? And then only allocate a small amount, say like 5%, 10%, 15%, only those small amount to risky investments, right? You avoid everything in between. You avoid any medium risk investment. So in this way, you are maximizing your upside because you have this risky investment which have high growth potential, but you also have your safe investment. And even if you lose everything, even if it goes down to zero, you still have your safe investment. You still have like that 80, 85%, 90% of your investment still there. So what happened in my case is that my risky investments did amazingly well, and it just kind of overshadowed the whole portfolio until it became like a relatively, in fact, incredibly risky portfolio. But rest assured, everyone, I have taken profit. It is important to take profit. But essentially, this is the strategy that I use. And again, I just want to say to everyone, like if in terms of making high risk, high reward decisions, there are people out there who can be a little bit binary. Like, for example, they are like, I have recently read on Twitter about this one person, like during the glove rally in, when was it, last year, 2020, this person took a personal loan, hundreds of thousands in personal loan in order to get into the rally, and lost everything. So don't have like this super binary. Only if you want to do this kind of things, like this risky investments, only out of your safe investments. Don't take any like weird leveraging strategy. Maintain 5%, 10% is okay. Don't take any loans. Try them out. If it works out, great. If you lose, you still have your remaining safe investments.
Suraya, thank you for that. And I think it's really important that you emphasize the context when it comes to your strategy, right? Because at the end of the day, ladies and gentlemen, it's important to find a strategy that works for you and your risk tolerance. If you end up going high risk because you think that's the only way to get high return, but when the market starts to shake up, and you can't sleep at night, then that's a great way of knowing that you are way too either over leveraged or your risk tolerance is not in line with the assets that you're owning at this point, right? And it doesn't matter whether the investment works out or not. How the investment works out is irrespective of your process, right? They're two different things. You have to do what's right for you. And yes, sometimes a lower risk tolerance means that you have to have a higher savings ratio to get where you want to. But that's important to take note of. And if I take a look, if I might share a little bit, my own investing style has changed a lot over the last few years. Over the last decade, really. I started off with a very sizable position in Apple, which grew exponentially, right? And I also got very lucky with that, if I'm being totally honest. And then sold out at a point where it continued to grow another 5 times after that. But it was way beyond my risk tolerance. I literally could not sleep at night worrying about whether it would fall. And that's because that's how big of a position it was in my asset allocation. This is why people talk about diversification or portfolio allocation or having different kinds of ratios or the rule of 100. All of this is so that you are able to invest in a way so that you can invest for the long term, because the magic of compounding, which is something, again, you can look up, but compounding is basically how wealth grows over the long term. And that magic really kicks in, or the inflection point is around year 20. 20 years is a long time to look and sit at your investments. But after that point, it really starts to see that exponential growth. So it's important to be patient. It's important to understand what you're investing in, even on a basic level. There are a lot of ARK investors right now who are feeling a lot of hurt and pain because if they jumped in, or even, as Suraya mentioned earlier, rubber glove manufacturers, there was a lot of hype back then. Bubbles happen. That's just part of financial history. It's important to invest in a way that suits your positioning and your goals, and not to catch up with the herd, right? In both ways, when people are selling and when people are buying. Ken, I do want to move over to you right now. When we take a look at Malaysia as a nation of investors and wealth builders, where is the country? And, basically how many Malaysians are actively trying to grow their wealth? And how is HSBC making wealth accessible to the general public?
Sure, Roshan. I see Malaysia as a developing nation, rife with potential and possibilities in the wealth space. In fact, a recent survey found that 17% of Malaysians are eager to start investing to better manage their finances amid this pandemic. So this is actually really a significant number of people who already view investing as an avenue to better financial well-being, right? And what's left really is for them to provide them the tools to do so. So as HSBC, as a wealth solution provider, we're committed to ensure as many Malaysians as possible are able to access our services. We firmly believe that it starts really with education, and it's the reason we are here today with Suraya and Raymond to have a real transparent conversations and discussion on building wealth, having a greater insight to their wealth journeys, as well as also both being very inspiring and highly informational. I mean, I certainly wish, I had this when I started out my investment journey.
Thanks for sharing, Ken. And it's true, right? More and more Malaysians are slowly but surely educating themselves. While that may be fragmented and different areas will see different rates of learning, but it does go to show that we as a nation are on the right track, right? And having said that, there are still a lot of us who could use more guidance, more assistance to kickstart the wealth journey, or at least setting the baseline, right? How do we know what to do? How much do we know where to go in terms of our financial positioning and financial situation? And Ken, I'm sure you get this particular question from time to time, given what you do. So from the perspective of a financial institution here, what can we do to ensure that our financial health is tip-top, right? Especially for the uninitiated. Is there a way to go about our understanding of our level of financial fitness beyond the budget trackers that are available?
Yep. So HSBC, for us, we want to make wealth accessible for all and help varied segments of the society to participate in the world of investments to achieve their financial freedom. Now, with over 150 years of experience in building wealth for individuals, businesses, as well as nations, we have actually demonstrated a track record as a trusted wealth advisor that can journey with Malaysians on their road to wealth management. As an international wealth provider, HSBC has a complete suite of tools and wealth offerings catered to the various stages of the investment journeys. One of these tools is actually the financial fitness framework that we put together as a guide for Malaysians to understand their level of financial fitness. Maybe with this, I can just ask to share a simple 3-step. Sure. So what I'm going to run through very quickly, it's a simple 3-step financial fitness guide, if we could call it that. Yeah, as you can see, so these are essentially 3 simple steps. 1, getting to know yourself. Secondly, assessing your cash flow, which Roshan, you have actually touched on earlier on. And then really then the next step is what's next? What actions to take? So, yep. So like as I mentioned, step 1 really is all about getting to know yourself financially. I mean, this really entails understanding your current lifestyle, your commitments, and if you have sufficient emergency funds to fall back on in the event of unforeseen circumstances. I mean, in addition, you will also need to ask yourself some questions using a forward-looking lens. For example, do you intend to have children? And if yes, how do you intend to fund their education? Jumping further ahead, what about your retirement? Do you intend to enjoy the same lifestyle in your golden years as you are today? So the second step is really about assessing your cash flow. And again, Roshan, you've touched about this briefly. So I'll just quickly illustrate, right? Take this example that you're seeing on the screen here. This is a scenario of someone in the M40 income bracket with 5.4K monthly income. This is after deducting EPF and taxes and all. Now, factoring in the monthly expenses of 2.75K a month, this leaves a net positive cash flow of 2.65K per month. Now, at this point, one checkpoint to note is that the current cash flow is actually positive, which is good, and the score here is 1.96. The general rule of thumb for a healthy score, it's 2. So where in this case, it basically implies that the person should either 1, look to reduce living expenses, for example, things like entertainment expenses, which can be, obviously you can further reduce, right? Or 2, ways to increase income, for example, in the area of passive income. So based on the previous info, now assuming the person has a monthly commitment of 1.8K and putting aside about 500 ringgit per month as discipline, good practice for investment purpose, he or she will have a net worth of 1.6 million at age 60. Now this is against, we're assuming the person is right now at the age of 25, so much younger and just starting out. So about 35 years, right, until retirement age. So based on that, and assuming an annual return of 5.5% with an inflation rate of 3.5%. Now, however, assuming that the person lives to the age of 77, he or she needs 2.1 million to enjoy the same lifestyle as today Hence, there is a gap. Right? This is represented via the financial fitness score of 76%, which you see at the bottom, highlighted in yellow, where to be financially fit, one needs to score 100 or higher. So then this really brings us to the last step of the guide, which is then really planning for your financial fitness. And what it basically means is, the key here is really talking about taking action. What you're seeing on the screen are some of the tools available online, not just at HSBC, to help with things such as budgeting and enhancing your financial knowledge. I mean, even simple steps such as increasing your savings via things like fixed deposit will help you in the long run. The key really is to make your money work harder for you. In addition, HSBC provides tools such as Easy Invest, which enables one to start embarking on the investment journey via unit trust with just 5 simple steps. There are also a wealth of info and insights available at HSBC. This is on our public website to support someone who is new to the investment journey, or at the other end of the spectrum, someone who is experienced investors. I mean, the key really is, remember, is to take action. Otherwise, a plan is just a plan. If you're interested to have a more comprehensive discussion, please consult a financial planner or a HSBC banker who will gladly take you through the financial review discussion.
Ken, thank you so much for that. And I think the slides there in themselves, very, very detailed, right? But what we're showing here is essentially the important process of going through your finances. And I like to use the illustration of GPS essentially, right? A map. I mean, it's one of the easiest things to understand. You take out Waze, if your location is not on, that means you don't know what your current financial position is. Even if you know where you want to go, there's no route that can be plotted for you, right? Or you could be going the complete wrong way. And vice versa, you may know your financial position today, but if you don't have goals or kind of aspirations in terms of where you want to go, then it doesn't matter what kind of routes you take, because you have no kind of, what's the word here? End destination or end point in that situation. So that's why it's important to assess these kind of factors here. And actually, if I could just share, over at RinggitPlus, we do have a cash flow budget template that you can download if you want. You just have to search RinggitPlus Resources Library over on Google, and you should be able to see the link there. And it's called the Smart Budgeting tool, essentially. But as we move on from there, we are actually now arriving at our final question, really, before we go into the Q&A, because I do see quite a lot of questions coming in. And this final question, I think, directed to both Suraya and Raymond. And we'll start with Raymond first here. Raymond, what are your thoughts on the recent financial trends, and what should Malaysians look out for when it comes to personal finance? Because as a little bit of parting advice, how can they take charge of their wealth journeys?
Thank you, Roshan. One of the most important tips of all is to actually invest as early as possible. The younger you invest, the better it is for your future. I truly believe that investing, it is not only about going through those journey itself, but it is also a good habit that everyone should develop at a very young age. So, example, if you're a parent, you can actually start with the habits of guiding your kids how to menabung or saving up from there. And when they are legally able to invest, this is where they start to take their money and start to manage their money on their own. So you can start as low as RM1 itself, because there are certain platforms that you're able to invest with as low as RM1. And of course, you can try to invest with RM50 as a start per month, then eventually increase it more as you grow older, as you are able to have more income to invest. So you can look into unit trust, ETFs, robo-advisor, where they are focused on selected sectors. And from there, you are able to look into countries as well, because some of the unit trusts, they do have certain focus on countries or sectors. And as a new investor, you should know what you're investing in. Similar what you're doing before you go for a holiday, you'll be serving the best food around those areas itself. Similar to investing, do your own studies. That's the financial do's. And as for the don'ts, never listen to your friend, because words are free. Your friend will always give you the best advice possible, but how true is their advice, or how reliable is their advice? So always do your due diligence before you listen to your friend to tell you what's the right thing to invest or what's the wrong thing to invest.
Raymond, thank you for that. And Suraya, what about you? Same question here. What are your thoughts on recent financial trends? And what is basically some parting advice on how individuals can take charge of their wealth journeys? Any particular points you want to stress here?
Thanks, Roshan. I actually love what Raymond said, but also I'm going to confuse everyone by giving a really hot take. I'm gonna okay. So when Raymond says that you should absolutely, be careful and learn everything that you can, right? That know what you invest in before you invest into it, right? This particular advice only applies to people who take too much risk, right? The people who are overconfident, the people who are, like a bit on the gambling speculative side, absolutely take this advice. And the thing is, like, they will only only the experience of losing money can humble them. So leave them do this thing. There's so much cost that you can do, but at the end of the day, it is really up to them to like scale it back. But I'm going to give another type of advice for the people who are on the other extreme end, the people who don't take risk at all, the people who are maybe, like you're scared to invest. And even when you hear things like, learn everything that you can before you invest. Even now, I have very little idea into EPF, and I invest in EPF. So I think that if you are that person who's like overly scared to invest, you're overwhelmed with all the choices, you right now all your money is only in your banking account, then perhaps that kind of advice, you might use it as an excuse to never take action. Like you just like go webinar after webinar and just learn, but you never actually put your money to work. So I'm just gonna give here, my take is that, there's a lot of noise inside the investment world, and there's so many even like contrarian and like different advice. I just gave you like a completely different side of what Raymond advised. So I'm just gonna say, forget all of this stock picking, forget gold, forget property, forget all that. Just focus on mutual fund, just focus on unit trust. Okay. People forget that mutual fund and unit trust is already a lot of options. EPF and PRS, that's private retirement scheme, those are also mutual fund. And then you get tax relief some more. If you have children, check out SSPN. That one you save for your children's education, that one also got tax relief, right? Other options are like ASNB fund, Tabung Haji, there's investment apps like robo-advisory, unit trust. Ken was too nice to talk a little bit more about the HSBC Easy Invest, but I checked them out and they have like a promo now where you can get extremely low sales fee. I believe it's like 0.88% of sales fee, which is very, very low. So you can try all these different things. Just concentrate on mutual fund, unit trust. When people talk about like, oh, should you go into like, stock here, stock there, just forget about all that. Focus on increasing your income so you can invest more every month. And that is it. Your retirement is secure. You're good. You don't have to be too overwhelmed with the other options if you just focus on the, the diversified funds only. That's something that I believe in. And, like another thing, right, just in case anyone here is that you've been on this learning journey, but you haven't taken that step yet. Honestly, I'm like that too in the beginning, but nothing will motivate you to learn more about what you're investing when you're actually invested. So when you are invested in something, that's when, like when you open the edge, you'll be like, oh, something about EPF. Now I'm interested in EPF. Oh, something about, this particular fund. Now I'm interested. So you can read all the theory you want, but you don't build that confidence and experience if you don't actually get started. So just get started. You have more than enough tools. Start small is fine, like what Raymond said, but you can forget all of the noise. Focus on mutual fund, focus on unit trust, you're good.
Soraya, I think you basically just, what's the baseball term, home run right there in terms of the kind of context that between Raymond and you in the last 5 minutes, we've covered a lot of essential advice here, right? And from two very different angles, which is important because personal finance is very personal. It really depends on you. If you're conservative, then there's a whole different strategy for that. If you're aggressive, there's a whole different strategy for that. If I know a client is aggressive, I'm going to talk about the conservative things to balance that out. And if I know a client is conservative, I'm going to talk about the aggressive things, right? To kind of balance it out. And ultimately, what you invest is where you go, how much you put into money, how much you save, depends on the financial goals, depends on your retirement goal, depends on the education funding you want to build for your kids. All of that is very variable, it's very different from person to person. Now, we have a couple of ground. I do want to get to some of the questions because a lot has been shared here, right? So thank all of you so much for your generous sharing, Ken, Suraya, and Raymond. This brings us to the end of the panel conversation so far, but I'm sure there are, and I know for a fact, there are plenty of questions that are piling up in my list over here. So with that, let's open the floor to the Q&A questions. Ladies and gentlemen tuning in, it's not every day we get all three of these panelists to sit down with us and be able to dive into some of these questions. So I'm going to touch into some of them right now. I'm going to start by answering one question on my own straight away, okay? Because I saw this in the chat box and I thought it was really, really important. This is from Kristen Wong. It requires a lot of effort to use expense trackers, keying your daily expenses. Any pro tips on how to be an active tracker? I tend to forget what I spent on the end of the day. So, Kristen, sorry, panelists, I'm just going to very quickly address this first. If you're someone like that who is not a full-on financial nerd and you're not tracking everything, first, if you want to use an expense tracker, look for the big things, right? At least track the big things that things that you're spending. Let's say above 50 ringgit, right? Now, if that still doesn't work and you're still failing to track all of that, then there's a whole different system for you to use that I personally like to use this. I use expense tracking as a secondary system to just verify the purchases I'm making and make sure I'm not overspending. But my first system is what is called income minus savings equals expenses. And there are many variations of this, whether it's called the future self bill or whatever it is. Essentially what it is this. You decide upfront, I'm going to save 10, 20, or 30%, whatever amount works for you, right? Start with a small amount and build up. And then immediately when your salary comes in or your income comes in on a monthly basis, take that out and put it into a separate account or a money market fund or a FD, whatever works for you in terms of stable assets or into your investment vehicles. Now, whatever's left in your main bank account, your transaction bank account, you can use it for your expenses, and you can use this however you see fit. Now, this is a very simple way to get it done because you've already done your savings. So that's where income minus savings equals expenses. That's how it works in this situation. It's simple, it's effective. It takes out a lot of the brain power involved in making sure that, oh, did I spend 2 ringgit on teh tarik yesterday? Or, hey, last week KFC I had how much did I spend on that? You can waste a lot of time on these little things when you should be focusing on how you're allocating your money. Now that I'm done talking, sorry about taking more valuable time from the panelists over here. Let's talk about some of these really great questions that we've got here. Let's start with Ken. I actually want to bring this up with you because we talk about inflation a lot, and now inflation is very hot. It's like, yeah, in the US it's 6-7%, but here it's been still around 3-ish% thereabouts. When we do retirement planning, right, in the financial planning space, we use inflation and a long-term average inflation rate to plan, right? Because you need to estimate how prices are going to go up. In your viewpoint here, what is an appropriate inflation rate to apply over the next 20, 30 years on average? Now, we don't want to use 7% because the hope is that it doesn't stay at that, right? It will normalize or moderate at some point. What are your viewpoints on this?
Right. Well, that's a bit of a tricky one. I guess. Well, before that, let me just say one thing, right? I think this saying is very true. There's only 2 certainty in life. 1, tax. 2nd, inflation. And both are obviously not good news to us. So on that score, to your question, Roshan, on inflation, I think it really depends on the cycle. But if I were just to put a number to it, and this is just very intuitively, right? I would say it's anywhere between the 3 to 4%. Typically, it'd be like somewhere close to the GDP growth of the country. GDP is a measurement of the economic growth, right? But slightly lower. So ballpark, I would say is around that.
Okay, Ken, thank you for that. I'm going to jump over to another one. I'm planning to take a break, career break for a few months. Do you think it's acceptable for me to use my emergency funds during my career break? This is a great question because now we're talking about where do we use our emergency funds for, right? I'd like to throw this question to both Raymond and Suraya. Given that we've only got 10 minutes, guys, try to keep it as brief as possible and hit the main points. But Raymond, can we get your thoughts on this first?
In terms of career break, go ahead. I think that one of the things that many people, when they deal with like work stress and all, and this is where your like emergency savings do actually come handy when in terms of after you've been working hard for like at least 10 to 15 years or maybe 5 years and all, if you feel like taking a career break and use your emergency saving, go ahead. But ensure that you have a plans like how long do you plan to take this break on and how are you able to manage your money. So example, if you have like 10,000 ringgit and you plan to have like 6 months of career break, divide those 10,000 by 6 months and see how much you truly have. And from there you can determine like is 6 months truly enough for me, or I want to reduce it to 3 months instead? So look into all this and calculate based on your daily expenses. And I imagine that if you're not working and all, that also means that you're not going out that frequent, you're going to stay home, or maybe you're going to go for holiday. So factors all these things into your expenses as well.
Thank you, Raymond. Suraya, anything to add to that?
Sure. What Raymond said is perfect. Just want to add on one additional thing, and this can answer like 80% of all the other questions. If you have money for it, roughly 1,000, 1,500 ringgit to start, I highly recommend for you to take a financial planning session, and RinggitPlus does offer it as well as some other places. The reason is because many of you who ask all these questions, you are having a lot of financial anxiety, and to a certain extent, you don't know what you don't know. Many people have this. You don't know yet what are the expenses that are unknown to you that you may have to plan for. So by having a professional service such as a financial planner, he or she will be able to sit down with you and actually go through the numbers, right? I can tell you, yeah, for sure, go and take your sabbatical, but I don't know the number. I don't know how much you have in your bank account. I don't know your commitments. So by having this person who you can trust, who are bound by ethics guideline, and it also actually helps somewhat like a therapy session as well. You just tell them like, oh,
yes, very much so actually.
Therapy session. So if you have like 1,000, 1,500 ringgit, go ahead and do that. But if you truly do not have it all, and you are, I saw a question on that. Let me just go on that straight away as well. AKPK have an amazing debt planning. I forgot what's the complete name, but like a debt planning session, which you can book, and they will be able to help you to restructure your debt if you are overwhelmed with it. So I saw a question about how to do it effectively. Go and get help from AKPK. That is their job. That's why the agency is established.
Yeah, if you are in any form of debt concern, debt trouble, anything like that, go and contact AKPK because that's their statutory body that's been formed for this, right? An officer will be assigned to you. And I want to emphasize, it's a free service. There are lots of scams out there saying that, oh, you pay this fee, you get the service. No, that's all nonsense. AKPK is a free service and they're here to help you. So if you have debt issues, please get in touch with them. And to Soraya's note on the financial planning, and sorry, this is a bit of a plug of my own, but licensed financial planners have a fiduciary duty to you, whoever is the client, to basically comment on your financial situation, right? It's not about pushing particular products or anything like that. So as Suraya mentioned, something like it is a therapy session, but sometimes you really don't know what you don't know, right? And sometimes it's great to have a third party come in there. Again, just search on RinggitPlus.com. You should be able to find our services there, if at all. Ken, I want to throw another question to you, since we talked about debt, right, a little bit, and we've got a few more minutes here. Do you have a viewpoint when it comes to debt consolidation? And is there a strategy in mind in terms of what kind of best strategy in terms of balancing debt and investing?
Not really, actually. I mean, for HSBC, we're looking at overall from a wealth management perspective. It's more about growing your wealth and all. I would really have to say that at this point, I would defer to my fellow panelists because we're definitely not specialists when it comes to talking about restructuring of debt.
Right. What about in terms of having a balanced portfolio? Do you have because you can have various types of investments, right? We talked about asset allocation earlier. Unit trust is a big part of the Malaysian market, right? There's no two ways about it. What are some of the important things to note when it comes to balancing your unit trust or assessing unit trust funds that are appropriate for an individual?
Sure. I mean, I'll tackle that question as a simple question for a few angles. And I think I saw one of the question in the chat, right, which was talking about risk tolerance. How do we know our risk tolerance, etc., and so forth. Now, I'm just sharing with you the HSBC experience. What we have is a simple risk tolerance questionnaire, just simple 6 questions that will help us to identify whether you are a conservative investor, a moderate, or an aggressive investors. At HSBC, we lump them in 5 categories along that range. Okay, that's one. Number 2, as a general rule of thumb, how one should actually look at asset allocation, it's not rocket science. I would say that really boils down to age, one being one key factor. Second, at the different various life stage. For example, if you are just someone starting out, you're young, 20, so you can afford to take risks. You still have a lot of working years to enjoy. That basically what it means is that 20 should roughly be representative of your allocation into defensive instruments. So i.e. the difference, the balance of 80 should be invested into risky assets, things like equities, to fully maximize your potential return. Now, on the flip side, if you're someone, say, 60 years old, on the other end of the spectrum, who's already like almost close to retirement or already in retirement, then your key objective will obviously be very different, right? Your priorities will be very different. You're here in the sense that you're looking to protect the nest that you've already built up over the years. So therefore, at 60, that roughly general rule of thumb again, that your age here represents how much you need to be invested in the safer instruments, things like bonds, fixed deposit, and so on and so forth. Now, then, of course, within that itself, like I said, this is just general guidance, depending on whether you belong to the more aggressive or the more risk-averse investor spectrum, that you can actually play around by, increasing or reducing the asset allocation into the risky assets. So I hope that answer question, Roshan.
Yeah, that was great, Ken. I mean, end of the day, what's important here is to note that your allocation will depend on your timeline to retirement. That's a big part of the process, right? And depending on the financial goal, a lot of it is about time. If you got 10 years, that will greatly change the asset allocation. If you got 30 years, wow, even better. The way you can do broad-based index funds, targeted unit trust funds, more equities into your portfolio to get that cash flow, to get that growth. What I guess is important to note here is that understanding what kind of timeline you have is one thing, but everyone who wants to learn more about this can read up on what is called the rule of 100. This is a very simple guideline that people use in terms of asset allocation. Right? And how simple is it? You take 100 minus your age to give you an asset allocation between growth and stable. Now, this is a guide. It's going to depend on your individual asset risk tolerance, but that's like a general guide here. And there are people who switch the rule up, right? I used to, on Ringgit and Cents, when I used to work at BFM, I spoke to a financial planner there who said he uses the rule of 110 or 120 for some clients because they're way more aggressive or they have different kind of goals, right? So that, again, guidelines are great, but as you go on your own journey, you will adapt it for yourself, right? Personal finance is very personal. I want to bring out a few other questions. Let's go to, this is a great one. I think, Raymond, this was inspired by your Warren Buffett quote a little earlier, right? Where be greedy when everyone else is fearful and be fearful when everyone else is greedy. So let's open this up to both Raymond and Suraya. And since it was, I think, spawned out of your quote there, Raymond, we'll start with you. Raymond, is this the time to be greedy? Put you on the spot a little bit.
Yeah, thank you so much, Roshan. We should always be greedy all the time. It doesn't matter during the market downturn, during market upturn itself. We should always be greedy. And the reason why I'm saying so is like, if we really look into the trend of investing, there is no such thing as the right trend to invest or the right time to invest. We should always stay invested no matter is market downturn, market upturn and all. And if you're always fearful or if you're feeling fearful like during the market downturn, just put the amount that you're feeling comfortable with it. It don't need to be like the exact amount that you used to invest during the market upturn, but of course, preferably try to invest the same amount of money and all because the power of dollar cost averaging works all the time. Thanks,
Raymond. Suraya, anything you want to add to that?
I don't really have anything good to add on to that, so let's just go with what Raymond said.
Ken, is there anything in particular you want to address there in terms of maybe something like dollar cost averaging or spending time in the markets as opposed to timing the markets? Do you have any viewpoints there?
Yep, I mean, you hit it right on the jackpot, right, Roshan? That exactly. I agree with what Raymond said. It's very difficult to time the market. No one can do it perfectly and sustainably. If someone will tell you to do so, I'll be hard pressed to believe, right? Even the world's most famous, renowned investors do not make that claim. So really, it's all about having the discipline, knowing what's suit yourself based on your risk tolerance, based on your time horizon or your investment horizon, and staying the course. Because as we've seen, especially right now, I would say we have so many noises, so many uncertainties, the geopolitical, and so on and so forth. But if you just take a look at the long-term track, I'm talking about 10, 20 years, 30 years, what does it show? It's basically on a uptrend. Obviously, in between, market doesn't go in one straight line. You will have fluctuations, and this is what we say, write out the noises. So it's going back to the old saying of, it's not timing the market, but it's your time in the market that is most important.
Thanks, Ken. And that is, sorry, yes.
Can I just add something? It's okay to be greedy because it's completely human, but try not to use money that is meant for your EPF to channel into your greed. So like if you want to try something, it's completely fine. But like make sure that you have done your allocation for EPF, all your unit trust, your monthly 500 ringgit into unit trust, your monthly 1,000 ringgit into another mutual fund. After that, if you have money left over, whatever that you want to do with the money is like completely up to you. That's my take on it. Yes.
Yeah, and I think that context is important, right, Suraya? Thank you, Suraya and Ken, for that, because again, personal. Greedy is also relative, and there are different degrees, right? And we use the term greedy because it sounds great, right? It just sounds sexy, but what it is taking advantage or constantly spending time in the market over the long term. It's not necessarily, Liana, great point. We need to be greedy intelligently. That's a great way, right? Responsibly and intelligently for your own context. So that means allocating no matter what, when the market is up, when the market is down. If you're also having a better understanding of valuations so that you don't get trapped by bubbles, right? There's so many of them out there. So that, if people are buying, let's say, what's the next big thing? I don't know, right? Well, let's say something happens and suddenly rubber gloves jump up again, right? Are there the fundamentals to support the kind of rally before you jump into that kind of thing? And dollar cost averaging is a really important concept here. It's not the most optimal or the most maximizing strategy, but what it does is it gets you involved in the markets. It's a reasonable strategy, a very mechanical strategy of investing at a regular interval, a regular amount of money into a quality asset. What is a quality asset? A broad-based unit trust fund, broad-based index fund, that sort of thing, something that works for you, and doing it over the long term. And that's really the context that's needed to bring this together. Ladies and gentlemen, we've got about 10 minutes, I've been informed, about another 10 minutes here because of the sheer number of questions that we've gotten. And I do want to switch the question a little bit over to talk about debt, because we've had quite a few questions that have come in about this. This question here is, how do we find a sustainable way to get out of debt faster? Now, as a financial planner, I do have a viewpoint on this, but I'm going to pass it to our panelists first. Is there anyone in particular who wants to take a stab at this question first? I'm not going to simply allocate this to anyone. Suraya, Raymond, Ken, anyone who wants to take this up first?
Sure, I'll take a stab. I'll just keep repeating that AKPK is a free service that you can make use of. Again, if you're overwhelmed, they will help and sit down with you and help you to restructure and actually help to approach banks on your behalf and give you either a better rate or a better, more sustainable amount to pay every month so that you don't default and affect your credit score. So contact AKPK. They are the best service that you can do right now if online options are not, if you're overwhelmed with information and online options.
Yes.
Like what Roshan said, there is no agent for AKPK services.
Yeah. Raymond, anything you want to add there?
Yes, sure. Yeah, actually, this is one of the topics that I personally do get into because I used to have situations where I got into such a huge debt and I managed to get out of the situation in few years' time. So I wrote a comprehensive ways of how to get out of debt. Of course, that's from my personal view and how I actually did it. But just to summarize in that is you have to find those lists of debts which is the alarming one and which is the less alarming one of all. And from there, target the alarming ones and try to pay off those alarming ones first and then slowly narrow down to those few other little ones. But at the same time, you're fully paying all, but select those alarming ones where you can able to overpay. Of course, if you do want to learn more on this, you guys can actually drop me a text on my Facebook page and all, and I will be happily share that blog to you guys for more details. Thank you.
Raymond, thank you for that. Ken, is there anything you want to add here?
No, not for me, for sure.
No worries. So I'm going to just round that up a little bit because what Raymond said is really important. What Suraya said is really important, right? So if you have debt issues that cannot be solved by reallocation of cash flow and cutting down your expenses or a debt consolidation product to refinance or whatever, then you've got to go and talk to AKPK. Okay, don't put your head in the ground like an ostrich, or don't chuck all the bills in the drawer and forget about it. It's scary, guys. It is scary, these kind of things, investing or even taking on debt. But if you continuously delay it, compounding is going to work against you. So your debts will compound in terms of how much they cost you. So to Raymond's point, in terms of how to attack debt, there are two ways that are very popular in the financial planning circles or the personal finance circles. These are called the avalanche method and the snowball method. two different ways. The snowball method is where you take care of the small amounts of debts first, so the balances of the smallest balances, so you get that off your books very quickly. So if you have so you don't even look at the interest rate, you just look at the balance amount and then eliminate that debt from your books. The avalanche method is where you go after the most expensive debt first. And this is the more effective, more rational way. But really, you have to know your own psychology. Are you someone who needs to build momentum, or are you someone who goes for the hard ones first? So the avalanche method is, let's say you have credit card debt, you tackle that first because that's effectively the most important. And then you go into other debt solutions that you have. It would be like if you have a PTPTN loan, pay that as you need to pay that, but you may not want to pay that off first before you pay off a higher or more expensive loan. All right. And it's just something to keep in mind that there are different products will have different interest rates, and that's something that you want to target in terms of your own debt situations. We've got I think we can do one more question before we wrap up. And I do want to target this question towards, I think we talked a little bit about it earlier, but this is a question directed for senior citizens. What is your advice for in terms of their investments at their, so let's rephrase this question a little bit. Let's say you're 5 to 10 years away from retirement. How should you be looking at your investments at this point, or your asset allocation? Ken, I know you talked about it a little bit earlier, so maybe we can focus it again, right? So for this very particular group, you're 45 years old, you're 10 to 15 years away from retirement. What are the things to be watching out here for in terms of asset allocation?
I think really there's the age, so which means that the older you are, the less or shorter is your time investment horizon, right? What that means is that your priority, as opposed to someone who has a much longer investment horizon, is to protect your nest egg. And what it basically means is that, to put it in a more practical term, is to have a more allocation into instruments or assets that are more defensive, things like bonds. If you can even go for like things like MGS, government bonds, even fixed deposit or cash equivalent. Or even if you go on stocks, it could be more like a blue chips high dividend stocks. So really, because for someone in that life stage, I would say it's more about capital or principal protection. That would be the first and foremost priority.
Stability over growth, right? At that point, Ken, basically coming down to that. Suraya and Raymond, do you want to chime in on this as well? Okay, cool. So no worries on that. We do have a comment I want to quickly address here from Azim in the chat. AKPK is for bankruptcy advice. Yes, basically you go to them if you have debt issues, and they will then negotiate with the banks in terms of restructuring the loans that you have that you can't pay for, right? It's important to note that you will not be able to take any new loans during this period, but they are very good at dealing with the banks and restructuring or refinancing the loan, right? So definitely something you don't want to procrastinate on, especially if you are in serious concern there. Or just give them a call, right? They are there for you in terms of, or at least for you to learn more about them. There is another question here. Do any of us have money in robo-advisors, or is that for total noobs? I'm just going to quickly just talk about this, and that is basically, it really depends on the individual, right? You can have an allocation towards it. Some people are a bit more skeptical because robo-advisor is still very new, that they prefer your ETFs or your unit trust funds who have had a lot more time in the market. That's why the asset allocation part is important, right? So that you can allocate different things. So why are you looking at the robo? Is there a particular reason you're looking at it? Does it have enough touch points for you to make you feel comfortable with it? And this is something I deal with a lot, right? It's very easy to say, oh, DIY, do it yourself, get the low fees, that sort of thing. But a lot of times people do need someone to talk to when it comes to their investing. And this is something I didn't appreciate as much before joining the financial planning space. So find the thing that works for you and then let the money compound over the long term. It's better than doing nothing with it. Is there anyone on the panel who'd like to add some points to that before we wrap up?
If I can just add on one thing, I see some of the comments go along this kind of line, like which one is better, ETF or EPF, or robo-advisory, or like this app A versus app B. There's really nothing stopping you from doing both, honestly. if you use the original principle of minimizing risk and you put like small amounts of money in obviously legitimate and licensed in Malaysia, companies that are licensed in Malaysia, put small amounts of money and you can try out all these different platforms. And I actually highly recommend doing this way as well, simply because not to have to be too diversified or anything like that, but just because in the future and even right now, you are going to see everything is going to be digitalized. So it is actually in your interest to learn about all of these different digital platforms. If at the end of the day, you decide that, let's say you have, 5 or 6 different investment platforms that you do, and you want to scale down to just 3, perhaps you can do that. It's easy enough to close accounts if you want to, but if you try out different platforms, they have slightly different way of onboarding their clients, slightly different questions. They can, help you to guide you towards certain funds better, perhaps. So try out these different digital platforms and see if you like the interface. Sometimes the debt preference as well. See if they give you good service. That is a good criteria as well. But you don't have to go which one is better. You can do both. And obviously minimize your risk.
Fantastic. Thank you so much for that. Raymond?
Yeah, I think one more important tips, aside from all the tips that Suraya is given, is also look out for all their management fees as well. Just make sure that all the investing fees can be as low as possible. Of course, there will definitely be some fees to it. So do your survey, look into it. Some management fees is high, some management fees is low. Try to go for the lower ones instead of go for the higher ones. But if assume those platforms are able to provide you with a good long-term return or based on their previous trend and all, if you want to try on it, just go ahead. But always look into their fees as well.
Raymond, thanks for that. We have run out of time. That's pretty much where it is, guys. Thank you so much for joining. I know there are more questions here. I really wish we could talk more about it. I think all of us have an Instagram and Twitter presence, so feel free to DM us there should you have more questions. Thank you everyone for joining us today. It's been a 1 hour, 15-minute session, more than the 60 minutes that we told you we'd take out of your time. So sorry for taking more of your time. Hope that's been of super value to you. Thank you for the great questions. Panelists, thank you so much for your insights today. I think everyone is just
thank you so much.
Thank you. Thank you.
Now, here's a little take-home task for everyone, right? Go home and assess your current financial position. Most importantly, remember, guys, the lifeblood of personal finance and your financial planning is cash flow. Where is your cash flow at, right? And 2 things to keep in mind are your annual expenses and your surprise expenses, right? Like your random trips. Account for that. Try and account for that by giving a little bit of slack to your cash flow. Once you have an understanding of your own situation, you can speak to a licensed financial planner like myself, or feel free to speak to any of the HSBC personal bankers as well to help you along your journey, your wealth journey. Before we part ways, ladies and gentlemen, HSBC would like to once again thank you all for taking the time out of your day to listen in on what was, I believe, to be a truly insightful discussion, but I may be a little bit biased in all of that. So thank you all and have a great week ahead, everyone.